If you are wondering about whether you should do a Roth conversion or how much you should convert to Roth, in this video I'm going to walk through the 5-step process I use with clients when helping them determine if they should do a Roth conversion, and if so, how much. Converting too little to Roth can lead to unintentional side effects like higher Medicare premiums, increased taxation on a surviving spouse, larger required minimum distributions, and higher taxes over time. Converting too much to Roth can cause you to unnecessarily pay taxes that you otherwise might not have had to pay. So how do you find the sweet spot? I'll walk you through the 5 simple steps I use with clients to help them with that decision and walk through a couple case studies so you can see how it's applied in real life. Here are the 5 simple steps that you can use for your situation. Step 1. Chart out your current and your future expected ordinary income against the current and expected tax brackets. Step 2, aim to smooth the curve and fill the lowest tax brackets. Step 3, decide whether that can be accomplished by changing contributions or if Roth conversions are needed. Step 4, decide how much to convert and when. Step 5, look out for landmines. First, step 1. Charting your ordinary income both currently and in the future. The key term is to define ordinary income. This is the portion of your taxable income, meaning after all the deductions, that is subject to the ordinary income tax brackets. If you have investment income, it could be subject to long-term capital gain taxes, which is different than ordinary income taxes. You could also have tax-exempt income from things like municipal bonds, which would not apply. For example, if you have W-2 taxable wages as a family of $200,000 and $20,000 in long-term capital gains from your investment portfolio, only the $200,000 is subject to ordinary income taxes. If your standard deduction is $32,000, then your taxable ordinary income would be $168,000. You'll want to chart out what you expect your ordinary income to be in the future as your income changes due to things like stopping work, collecting Social Security, and taking funds out of your 401k or another investment account. Now that you've charted out your expected ordinary income, both now and in the future, you need to put the tax brackets on top of it. Since not all ordinary income is taxed at the same rate. The higher the ordinary income, the higher the marginal tax bracket. One big assumption you will need to make is how the tax brackets are going to change in the future. Personally, I assume that they'll expand at the same rate as inflation. Once you do that, you will have a chart that looks like this, where you can see the projected ordinary income and which tax brackets it fills up. This is going to be your baseline to make decisions off of. Now, step 2. We will want to smooth the curve as much as possible and fill the lowest brackets. So we need to identify if there are any opportunities now or in the future where we may be able to put money into a lower bracket. Let's look at an example. So you can see on this chart we have the ordinary income mapped out for this client, and there's a number of years here where you don't see any ordinary income. It's because they don't have any source of income in those years that is taxable as ordinary income. Overlaid on the chart we have the tax brackets, the 10, 12, 22, 24% tax brackets. And you can see that there's an opportunity here to realize income in these earlier years at a potentially lower tax rate than the client is expected to pay in future years. It looks like we even have some income falling into that 22% bracket, and then ultimately when these brackets drop down, that's signaling the anticipated death of a spouse, which of course we don't know for sure until that occurs, but to see what would happen to those tax brackets when the older spouse passes away. You can see that they're moving into the 24% tax bracket. And so there's an opportunity for this client to move dollars into those future years, into those sooner years. Let's take a look at another. This one's going to be the opposite. So for this client, upon retirement, they're going to have a significant drop in their taxable ordinary income, and it's going to stay lower through retirement. So one of the things that we might want to do with this client is see how can we shift income from these earlier years between ages 49 59 and 57 and move it into retirement into the lower brackets here, potentially realizing some income at the 22% tax bracket instead of the 24% tax bracket. Now that we have identified whether or not there is an opportunity to pay taxes at a lower rate in the future, it does not mean that we should default to a Roth conversion in those years, especially if it's far out in the future. Step 3 is going to be deciding whether or not adjusting your retirement account contributions will sufficiently smooth that curve for you. If you're still contributing to your retirement accounts, you can choose, with some limitations, whether you want to make Roth contributions or traditional contributions to your IRA or 401k. If you anticipate having investment income as part of your retirement strategy, it's going to make a big difference from a tax perspective, whether you are distributing Roth dollars or traditional pre-tax dollars. Traditional pre-tax dollars are going to increase your ordinary income in retirement, while qualified distributions from Roth accounts are not. If you anticipate being in a lower tax bracket in retirement, you should consider making more traditional pre-tax contributions to your retirement accounts now instead of Roth, aiming to pay taxes on those dollars when you are in your lowest possible tax bracket. Inversely, if you anticipate being in a similar or higher tax bracket in the future, you should make Roth contributions instead. This is more straightforward in your 401k, 403b, TSP than it is in an IRA, where you can be phased out from making Roth contributions. You may also be phased out from making deductible traditional IRA contributions. If you can smooth the curve just by adjusting your contributions, I'd consider doing that instead of making Roth conversions today. Sometimes it's not possible, however, because of how close you are to retirement or because you're already retired, in which case we are likely looking at doing a Roth conversion. Let's take a look at another example. So you can see here for this client, we looked at it earlier, but he has very large RMDs projected at age 75 and is only 2 years away from retirement. And so this client shouldn't be making traditional contributions currently, because all it's going to do is add to his taxation down the road. We should instead be aiming to do Roth contributions, realize some more of those taxes now in those lower brackets. But he's so close to retirement that I'm not sure how much of a difference it would make for this client. Also, we'll look at one more where we have a little bit longer timeline until retirement. And again, our goal is to see, could we smooth this curve by making traditional versus Roth contributions in the future? And so for this client, they were making all Roth contributions to their retirement accounts, and we have 7 or 8 years until retirement. And so what we'd want to do here instead is defer the taxes into these future tax years when we're at a lower tax rate and make traditional contributions instead, try and move some of that income from these earlier years into those later years where it can be taxed at a lower rate. Next is step 4. Decide how much to convert and when. Now that we have identified when is going to be the best time to realize income by smoothing the curve, trying to fill up those lower brackets, we can figure out when and how much the conversion will be. It will typically be limited by one of two things: either the top of a tax bracket or the top of a Medicare premium tier if you're age 63 or older. I typically start with seeing what would it look like in the lower income years to convert up to the top of the desired tax bracket. I then look at whether or not it would have an impact on a client's Medicare premiums. If it does, we need to decide whether the income tax savings outweighs the additional Medicare premiums. If so, then it may be a good move. If it does not, the conversion amount might need to be limited to stay below the Medicare premium tier threshold. Let's take a look at another example. So for these clients, one of the things that we may consider doing is conversions in these years where there's some room within that 22% bracket. If, however, we look at their Medicare premium tiers, we can see that if we did any meaningful conversions in those years, we'd move them up at least one, if not two, Medicare premium tiers, which could result in thousands of dollars of additional Medicare premiums, which might completely offset the lower amount that we would pay in premiums. Another example is for these clients, considering doing Roth conversions here in the early years, some small ones because their ordinary income is pretty low. However, when we look at their modified adjusted gross income, which is what determines those Medicare premium tiers, we can see that there's actually not that much room, again, to be able to do a conversion. And so for these clients, even though it might make sense from an income tax standpoint, those savings might be completely offset by those additional Medicare premiums. For most people, they are 99% of the way there after step 4. Step 5 is the last 1%, and if not done, it can create a ton of headache in the future. Step 5 is look out for landmines. Landmines are things that if you don't look out for, it could blow up your Roth conversion strategy. We're going to go rapid fire through some of these just so you know some of the things to look out for. First is how you plan to cover the tax liability. If you are 59 and a half or older, you can withhold on the conversion for the state and federal taxes. It's typically preferable, however, to pay from non-retirement accounts instead. If you are less than 59 and a half, withholding for taxes on the conversion itself will count as a premature distribution and cause ordinary income taxes plus a 10% penalty. Second is making sure you are appropriately tracking IRA basis. IRA basis is the cumulative amount of non-deductible contributions you have in an IRA. If you don't track this appropriately on Form 8606 on your taxes, you could accidentally pay income taxes on the same money twice. Third is to consider whether you plan to do any qualified charitable distributions or QCDs in the future. QCDs are for people 70 and a half and older, and it's when you send dollars directly from your IRA to a charity. This becomes an above-the-line deduction and allows you to avoid paying taxes on those dollars ever. You certainly don't want to convert traditional IRA dollars to Roth that you were planning on gifting charitably. You would unnecessarily pay taxes on them. Fourth is to consider your proximity to the next long-term capital gains tax bracket, especially if you're in the 0% long-term capital gains tax bracket. A Roth conversion could move you into the next bracket, for example, the 15% bracket, and subject your long-term capital gains to taxation when they otherwise would not have been. This doesn't completely rule out a conversion, but it should be factored in as an additional cost. Fifth is similar, and that's net investment income tax. This is an additional tax that is applied to investment income if your modified adjusted gross income is above a certain threshold. Roth conversions can increase your modified adjusted gross income and potentially subject your investment income, like dividends, capital gains, and interest, to additional taxation. Sixth is something that is also impacted by your modified adjusted gross income, and that's health insurance premium tax credits. Especially with the current environment and the elimination of tax credits if your income exceeds 400% of the federal poverty level, this is a big one. If you are on marketplace insurance, be extra cautious when considering a Roth conversion, or it could come back to bite you. Seventh is also tied to health insurance, and we've mentioned it before, but that is Medicare premiums. Most people are not aware that their Medicare premiums are determined by their modified adjusted gross income from their tax return 2 years prior. If that income is above a certain threshold, you could pay higher premiums for the same Medicare. Eighth is how Social Security is taxed. Anywhere between 0% and 85% of your Social Security benefits can be included in your taxable income. There is a formula called provisional income that dictates how much of your Social Security is going to be subject to taxation. It doesn't take a ton of income to be at the 85% end. But if you're one of the ones whose Social Security is non-taxable or less than 85% taxable, then be wary of doing a Roth conversion because it can cause more of your Social Security to be included in your taxable income. Ninth is the impact on different credits or deductions you may be eligible for. A lot of credits and deductions are tied to your modified adjusted gross income, and when it's too high, you become phased out for certain credits and deductions, like the child tax credit, the senior deduction, qualified business income deduction, and a host of others. Now, this is not an exhaustive list of landmines, but these are the most common ways that Roth conversions can have unintended adverse consequences. I highly encourage anyone who's considering doing a Roth conversion to consult a financial professional before making an irreversible decision. I do dozens of these each year, and some of them are pretty straightforward, and others are much more complicated to calculate. In some situations, there can be multiple landmines that we're working around. I encourage you to apply this 5-step process to your situation, and if you need additional assistance, feel free to reach out to me or another financial professional to help walk you through that process. I'll link a video here to help you find a fee-only financial professional near you.